Hi, I'm Kara Murphy, and this is Money with Murphy. Earlier this month, a new bill passed into law, officially called One Big Beautiful Bill Act. While the name might be playful, the bill has a wide range of implications for businesses, investors, and individuals, some of which are controversial and others complex. The Congressional Budget Office projects the bill will increase the federal deficit by over $3 trillion over the next 10 years, a topic we covered in more detail last month. It also reduces spending in several government service programs, which has sparked debate. Today, however, we're going to focus on a different angle, a series of tax credits designed to boost investment. First, higher bonus depreciation. The bill gives companies new and permanent tax incentives to spend on things like machinery, equipment, research, and manufacturing facilities. It restores the 100% bonus depreciation provision that was previously scheduled to phase out. Under this law, companies can immediately deduct the full cost of qualifying equipment and property. Think expensive machines, trucks, semiconductors, thereby reducing their taxes. Before, they had to spread those deductions over many years. So it creates a significant tax incentive, freeing up cash that businesses can use to reinvest, expand, or hire. And it's permanent for qualifying assets. That kind of predictability makes it easier for companies to plan big, long-term investments. Two big groups of companies stand to benefit. The first, capital-intensive companies, like those in manufacturing, energy, utilities, transportation. They spend heavily on equipment each year. The second group are suppliers, companies that make or sell that equipment. With more businesses buying equipment to lock in tax breaks, demand for these suppliers' products could rise too. The second important provision is an increased tax credit for manufacturing. The law boosts the tax credit for advanced manufacturing, think cutting-edge technologies that improve factory efficiency and productivity, raising the credit from 25% to 35% of the investment. That's especially meaningful for U.S. chip makers, who are at the heart of everything from smartphones to artificial intelligence to cars. The bill also locks in favorable tax treatment for small businesses, making it easier for them to deduct the full cost of short-lived assets. And importantly, it makes research and development expensing permanent, removing a major barrier to innovation. Third and finally are changes to international taxation. The law makes numerous changes to how U.S.-based companies with overseas earnings are taxed. While there are both positives and negatives depending on the company, the new rules provide U.S.-based global businesses with simpler calculations and greater long-term clarity. That allows multinational companies to plan more effectively. In sum, these rules are designed to encourage companies to invest, which ultimately should help corporate earnings. So thanks for watching, and until next time, invest wisely and live richly.